let's turn to question number 4 is debt markets. So we've been focusing a lot on banks, but let's also focus on other debt markets that also include public debt, private debt, commercial paper, and other sources of funding. We can classify that into investment grade, non-investment grade, short-term, long-term, secured, unsecured. So many ways to classify it, but how do we expect debt markets to respond in the short term and then over the medium term?
I think, if you're managing a debt portfolio, the risk, there's no question this could be a big, slew of downgrades coming up very soon from rating agencies, and that's going to force certain funds to actually sell. Because once, if you're running an investment grade fund, something drops to non-investment grade, you have to sell.
Yeah,
so there's going to be a lot of technical pressures for that. That people should be aware of, and then you have to sit there and, if you're invested in a fund, see what the ratio of triple Bs are to the rest of the portfolio, because they'd be more, they'd be more forced selling the more concentration there is on the lower part of the debt rating structure.
And I agree with you, and that always has an impact because, as I said, what happens in debt markets has a lot to do with portfolios and investment portfolios. And if it becomes non-investment grade and they can't hold it, they got to sell it. Yeah,
and already what's happening is this, the activity in the high yield market is decreasing already. So if you have additional technical reasons that people are trying to force sell, it'll drive that even further down, the pricing.
Now, I'm also thinking of this in terms of the corporates themselves. So some corporates themselves will say, well, can I go into the debt markets? Can I issue new paper? Can I refinance debt? Is it going to be closed, or will I have to do it at higher prices? I think it's almost obvious that in a deteriorating market, credit spreads are going to be higher, so you might have to do it at higher yields, higher pricing. Some CFOs or treasurers are going to say, 6 months from now, is there going to be a viable public debt market to be able to issue?
My thought is yes, it'll cost you, but I think that the reasonably strong companies will still be able to survive that because their business model and is strong enough. Even if you look at the loan market, for example, for leveraged loans, if you kind of go back to the peak, pre-crisis, even last year, 68% or some high number of leveraged loans ended up in CLOs. So that was the biggest buyer for leveraged loans in the world. So you have to kind of keep track of what's happening in the structured credit market to see if that buying base is still there or not.
And that buying base is really subject to the formation of new CLOs or reinvestments within CLO structures?
It's really a function of, are there investors for CLO tranches across the entire capital structure? Because pre-crisis, AAAs used to be LIBOR plus 25. Then after the crisis, it's LIBOR plus 125.
Yeah.
So the capital structures of the CLOs got rejiggered to be able to get financed. But if you look at what happened, 2010, 2011, there's a big decrease in the issuance of CLOs because the performance of older CLOs were poor, and that was because there were a lot of energy companies, oil companies in there that were doing poorly, and because those high yield oil companies were doing poorly, it reflected on doing poor performance, and that trickled down to the CLOs, which decreased the demand for CLOs, which then decreases the buying base for new and issuance of new leveraged loans. So it's really it's a vicious circle.
Yeah.
So the lesson for that is just how interlinked the markets are. If it's leveraged finance to CLOs to private equity, so fewer private equity deals were being done because so even though the driving factor was a decrease in oil price, which drove high yield oil companies out of business, they couldn't pay their loans, which affected the performance of the CLOs, which meant fewer new CLOs were being issued, which meant that there were fewer loans being financed, and that meant that private equity groups at banks weren't able to actually even get advisory business.
It's a very good example of how interconnected these markets are. The other thing is, as I said, I think when we start looking at these debt markets, we cannot diminish the importance of CLOs, as you said, in leveraged markets. I didn't realize that this number had exceeded 60% in terms of the participation in leveraged loans. And
it was 68% at its peak.
Yeah, I mean, that's a substantial, it means that there's a substantial player in leveraged lending. So one thing I do think, especially as it relates to banks and bank syndications, I think what we're going to see is that banks will say, we will participate, we will support, but we got to protect ourselves. And so I think you're going to see really tight structures. And so, whereas before you might see, say, bank syndications and bank lending with what we call covenant light, unsecured long-term exposures with very, very few financial benchmarks and covenants. I think banks have a little bit more say-so now in this type of market, and they're going to say, we'll support you as you get through these worst times, but the structuring and our protections are going to have to be tight. So that might mean that we need collateral, we need covenants, we need to protect ourselves to make sure that we're senior. We also have to protect ourselves possibly with amortizations of principal. So,
yeah, the entire leveraged loan market, I guess, it's almost all senior secured anyway. It's really the covenants which is the key component, to maintain that. I mean, and you'll appreciate this, but I mean, my first job in Wall Street came out of Jimmy Lee's world, leveraged finance world, because credit derivatives group was built as an additional funding source for the leveraged loans that Jimmy Lee was doing out of his leveraged finance group. So we were the original credit derivatives group to help mitigate the risk that the loan group was generating.
Yeah. So I think the trend there is that, we go through these periods of covenant light, covenant heavy, covenant light. Obviously, right when you go back to 2006, 2007, we saw a substantial amount of what we call covenant light deals coming out of the crisis. We saw a reduction in covenant light. And then over the last 4 or 5 years, we saw an increase in covenant light types of transactions. I think we're going to, as I said, banks are going to have the posture that we're going to have this cash, we're going to have liquidity, we're going to have sources of financing. We understand our role in this crisis, and we're going to be willing to step up, but we want to protect ourselves in better structures. So
definitely. And I think the CLO market is kind of a canary in the coal mine to see how well that works.
Yeah, I think that's very interesting to kind of see how that's going to evolve over the next in the periods to come. Now, one market you talked about, I don't have it here, credit derivatives, CDSs. Any insight, any thoughts about that particular market?
I mean, there's no question that liquidity after the crisis, decreased dramatically, and it hasn't recovered anywhere close to where it was during its peak. But I think it's still a market which people watch a bit, but it's just not as important anymore, just because the volumes aren't there.
Yeah. Now, looking at our balance sheet here, this is the balance sheet of a corporate, and we're looking at the right-hand side of the balance sheet of how that corporate will fund itself. And as I had said, we can categorize this in various ways: short-term, long-term, hybrids, and equity. So in the short term, what we're saying is that we've seen companies tap into their revolving credit lines. Most companies do have committed bank arrangements. And sometimes many companies, especially say AA, single A companies, they don't use those lines, but they're going to use them now. So we're going to see that in the short term. And then we're going to kind of have to watch what's going to happen in some of these other markets over a period of time. Now, this is a topic, this call is about debt markets, but I have to also ask, what about equity markets as a source of funding? Is that, for all practical purposes, going to be shut down in terms of issuing new capital to support the balance sheet?
I mean, the number of IPOs have been generally, I haven't watched the specific numbers, but generally it has been decreasing. The number of public companies have actually been decreasing. The combination of startups, instead of going public, will get bought out by Google or Amazon or Facebook. And then if you sit there and look at the PE business, they've been taking companies off the market. So the public markets itself is actually shrinking.
And so for all practical purposes, we're not, in terms of understanding what corporates are going to do to try to fund their balance sheets. This is not necessarily about shareholder value. This is about ensuring that the balance sheet and operations are funded as they go forward. Mm-hmm. Equity financing is going to be a minimal or source.
Yeah, I think so. I think people, like in times of crisis, people like Warren Buffett go out and try to get some good pref deals that are sweetheart deals for them. So I think that's kind of a more important market than just trying to do to hit secondary public offerings. I think that's more of a challenge.
Yeah, and Warren Buffett is the type that kind of likes to do a lot of convertible deals. So convertible deals where he can get some
people
cash
don't realize
flow.
that he gets sweetheart deals because of who he is, which is fine.
That's correct. And as I said, it's more likely I want a return, so I'll come in as a convertible bond and get my cash flow return, but I can also benefit from the upside. Company would like this, of course. You can get a substantial amount of financing at one time. Before I got on this call, I did notice that Airbnb had arranged to get financing in private equity financing. So I don't have the details of that, but it was able to do so, even though it's definitely exists in one of those troubled industries as we go forward.
Yeah.